Most people moving to Pennsylvania worry about property taxes. That makes sense. But here's what catches families off guard. Pennsylvania has this inheritance tax that starts at $1. No minimum state size, no dollar threshold. You leave your Doylestown house to your kids, the state wants 4.5% of the value on a clock before they can really do anything with the property. And if you're leaving assets to anyone who's not a spouse or a direct family member, that number jumps to 15%. I'm Jim Stevenson, a realtor here in the Philadelphia suburbs, and after working with relocating families for over a decade, I've seen this tax blindside people at the worst possible time. Now look, I'm not a financial advisor, I'm not a lawyer, I can't give you legal or tax advice. What I can do is tell you what I've seen work for families who planned ahead and what mistakes I've watched people make that cost their kids tens of thousands of dollars they didn't need to lose. So today we're breaking down the legal strategies that actually reduce or eliminate Pennsylvania's inheritance tax with real numbers, real scenarios, and the kind of local context you won't get from a generic estate planning article written for the whole country. Let's start with why this matters more here than almost anywhere else. Pennsylvania is one of only 5 states left that still taxes inheritance. The federal government raised the estate tax exemption so high that 99% of families don't owe a dime to the IRS when someone passes. But Pennsylvania, they don't care. They'll tax a $50,000 estate the same way they tax a $5 million estate. And here's the key difference most people miss. Pennsylvania doesn't tax based on how much you have. They tax based on who you give it to. The moment you step outside a marriage license, the meter starts running. Here's the breakdown. If you leave assets to your spouse, the tax rate is 0. If you leave them to your kids or grandchildren over age 21, it's 4.5%. To a sibling, 12%. And to anyone else, a friend, a niece, an unmarried partner, it's 15%. So if you buy a house in Newtown for $700,000 and you're in an unmarried partnership, your partner has to write a check to Harrisburg for $105,000 just to keep the house they're already living in. That's not a typo. $105,000. A marriage certificate is literally worth 6 figures in this scenario. And even at the 4.5% rate for kids, the math really adds up fast. That same $700,000 house, your daughter is writing a check for $31,500 before she can even decide what to do with the property. And that assumes she has $31,500 in cash sitting around. If she doesn't, she's either taking out a loan or selling the house to cover it. Now look, I know you're probably thinking this is an unfair tax, and honestly, along with most other taxes, that's a whole separate conversation. Whether it's fair or not, it exists, and families pay it every single day. So the question isn't whether you like the law, it's whether you're going to plan around it or let it blindside your kids when you're gone. Now you're probably thinking this sounds like something that only happens to wealthy families with complicated estates. That's not true. I've seen this play out with a $200,000 condo in Hatboro. I've seen it with a family in Warrington who thought adding their son's name to the deed would solve it. It didn't. In fact, it made it worse. We'll get to that in a minute. But here's the part that surprises people. It doesn't matter if the house goes through probate or not. It doesn't matter if you have a living trust. Pennsylvania taxes the transfer either way. The tax isn't theoretical. It creates a deadline. And deadlines plus illiquid assets are where families get burned. So let me walk you through what actually works. The first strategy is the most obvious, but it's worth saying. If you're married, make sure your major assets are titled jointly with your spouse. Tenants by the entirety for real estate. Joint ownership with right of survivorship for bank accounts and brokerage accounts. When the first spouse passes, those assets go to the surviving spouse with 0 inheritance tax, none. And in some cases, if everything was jointly owned spousal property, there may not even be an inheritance tax return to file. Your estate attorney can confirm based on how the estate is handled. This is the foundation. Most married couples already do this, but I still run into situations where one spouse's name is on the deed because they bought the house before they got married, or one person kept their brokerage account separate for some reason. If that's you, fix it now. Retitle the assets. It's a simple conversation with your bank or a quick deed at your attorney's office. Now, that doesn't eliminate the tax forever, it just kind of defers it. When the surviving spouse eventually passes and leaves the house to the kids, that's when the 4.5% kicks in. But deferring it gives the surviving spouse full access to those assets without having to immediately, liquidate something to pay a tax bill. That matters. The second strategy is life insurance. Under current Pennsylvania law, life insurance proceeds are exempt from inheritance tax. Whether it's payable to your kids, your spouse, or even your estate, it's still exempt. This is huge because it means you can create tax-free liquidity for your heirs so they can pay the tax on everything else without selling the house. I worked with a couple in their early 60s who owned a house in Doylestown worth about $600,000 and had another $400,000 spread across retirement accounts and some personal savings. They were house rich and cash poor, really a common situation in our market. They had 2 kids. They did the math, and when both of them passed, the kids would owe roughly $45,000 in inheritance tax on their estate. That's 4.5% of the $1 million going to the kids. So instead of leaving the kids a tax problem, they bought a life insurance policy for $500,000. When both of them passed, the kids got that $500,000 completely tax-free. That more than covered the inheritance tax bill on everything else, and the kids didn't have to sell the house or drain the retirement accounts to pay Harrisburg. Now, life insurance isn't free, you're paying premiums, and depending on your age and health, it might not be cheap, but for a lot of families, the math works. You're essentially prepaying the tax at a discount by using an insurance company's money instead of your estate's money. Since the payout is tax-free, it gives your heirs the exact amount of cash they need to pay the state without having to liquidate the family home. The third strategy is gifting while you're alive. Pennsylvania doesn't have a gift tax, but they do have a 1-year look-back rule. Here's how it works. Any gift you make within 1 year of your death gets pulled back into your taxable estate, except for the first $3,000 per person per calendar year. So if you give your daughter $50,000 and you pass away 11 months later, Pennsylvania is going to tax $47,000 of that gift as if you still owned it. But if you make that same gift and you live more than a year, it's completely out of your estate. Your daughter keeps the $50,000 and the state can't touch it. The challenge, of course, is that none of us know when we're going to die. So this strategy works best if you're healthy, you're planning ahead, and you're comfortable parting with that money now rather than keeping it for your own use. I've seen families use this really effectively. They'll help a kid with a down payment on a house in their 50s or 60s, knowing that if they live another decade, that money is out of the estate and the tax savings are real. But if you're doing this at 85 or 90, or if you're in declining health, the 1-year rule makes it a lot riskier. But here's the legitimate loophole in that 1-year rule. Even if you're on your deathbed, you can write checks for $3,000 to as many people as you want, and that money is immediately out of your estate. If you have 4 children and 10 grandchildren, that's $42,000 out of your taxable estate instantly. It's the only deathbed planning strategy that actually works in Pennsylvania. Now here's the trade-off most people don't hear about gifting. When you gift an asset during your lifetime, you give up the step-up in cost basis. That matters a lot in real estate. If a parent bought a home decades ago for $150,000 and it's now worth $700,000, gifting that home can create capital gains issues later that dwarf the inheritance tax savings. So gifting isn't good or bad, it's really situational. And it's exactly why this needs to be coordinated with a CPA and an estate attorney. One more thing on gifting. Don't confuse Pennsylvania's $3,000 rule with the federal $18,000 annual gift exclusion. Those are 2 different things. The federal rule is about whether you have to file a gift tax return with the IRS. The Pennsylvania rule is about whether that gift gets taxed if you die within a year. You can give $18,000 to each of your kids this year without filing anything federally, but if you pass away within 12 months, Pennsylvania will claw back everything over $3,000 per person. And if you're sitting here thinking, okay, Jim, this is more complicated than I thought, you're right. And this is exactly the kind of thing I walk families through when they're relocating here. Not the tax advice itself, but how these costs, really layer into your decision when you're comparing towns and trying to figure out your overall budget. And if you're still building your short list of homes or trying to figure out where you actually want to land in the Philadelphia suburbs, book a call using the link in the description. Or grab my free Philadelphia suburbs relocation guide using the QR code on screen. It breaks down the schools, the commute, property taxes, and what you're actually getting for your money in each area. All right, let's keep going. The 4th strategy is for families who own farms or small businesses. Pennsylvania has specific exemptions that can wipe out the inheritance tax entirely if you meet the criteria. For farms, the rule is this. If you leave your farm to family members and they keep it in agricultural use for at least 7 years, the inheritance tax on that farmland is 0. Not reduced, 0. The property has to generate at least $2,000 a year in farm income, which is a low bar, and your heirs have to file annual certifications with the state to prove they're still farming it. But if they do, you just save 4.5% or more on what's often the single biggest asset in the estate. This is huge for keeping farms in the family, especially up in, Upper Makefield, Plumstead, Bedminster, where we have a lot of land. I don't work with a ton of farm families in my day-to-day, but I know several agents who do. And, this exemption has saved families from having to sell off land just to pay the tax bill. For small businesses, the rules are similar. If your business has fewer than 50 employees, less than 5 million in assets, and has been operating for at least 5 years, you can pass it to family members with no inheritance tax, as long as they keep running the business for 7 years. Same concept. The state wants to, really incentivize, keeping family businesses alive, so they created this exemption. And this is huge for the local economy here, because so many of our contractors, landscapers, and local shops in the boroughs are family owned. If you're in that situation, this is one you absolutely cannot miss. You have to file the claim on time, and you have to follow through on the 7-year commitment. If you don't, the tax comes due with interest. Now let's talk about what doesn't work, because I see people make these mistakes all the time. We call it the convenience trap. You have a parent who's getting older, maybe their health is declining, and they want their adult child to be able to help pay bills or handle the mortgage if something happens. So they go down to the bank or call the title company and add the child's name to the deed or the checking account. They think they're just being efficient. In reality, they just created an immediate tax liability. Pennsylvania uses something called the fractional interest rule. If you add your son to your checking account, the state presumes he now owns half of that money. If you pass away, he has to pay inheritance tax on the half that transferred to him, even if he never put a dime in the account. But here's the part that's even worse. If your son passes away before you do, the state assumes he owned half that money, and you have to pay inheritance tax to inherit your own money back from him. I've seen this happen. It's really brutal. And it's completely avoidable by just using a power of attorney instead of adding them as joint owner. The power of attorney lets them manage their finances if you need help, but it doesn't create a taxable joint ownership situation. And there's actually a second layer to that joint ownership trap that hits people who try to do last-minute planning. Sometimes people realize the tax is coming, so they try to add names to deeds right before they pass. Pennsylvania is way ahead of you on this. The state has a strict rule that says if you create a joint ownership arrangement within 1 year of your death, they ignore it completely. They tax 100% of the value, not just the joint portion. They assume you did it to avoid the tax, so they claw it back. Another mistake, thinking of revocable living trust avoids the inheritance tax. It doesn't. Living trusts are great for avoiding probate. They keep things private. They make the transfer faster. But Pennsylvania treats revocable trust assets exactly the same as if you own them outright. The tax is the same. The only trusts that help with inheritance tax are irrevocable trusts that you set up well in advance, or certain special purpose trusts like a trust for a disabled child. Those are more complex, and you need an attorney to structure them correctly. Here's the last thing I'll say about this, and it's really the most important. If you don't plan at all, the default outcome is that your family pays the maximum tax the law allows. Pennsylvania is not going to call your kids and tell them about exemptions they missed. The state wants the money. It's on you to make sure someone in your family knows this stuff exists. I've been in situations where someone passed unexpectedly and the family didn't even know there was an inheritance tax until the Register of Wills sent them a bill. And by then, they'd already missed the early payment discount. Pennsylvania gives you a 5% discount if you pay the tax within 3 months of the date of death. That's a guaranteed 5% return just for being organized and paying early. But most families don't know about it, so they miss it. The flip side is that if you don't pay within 9 months, you're paying interest and potentially a penalty. And that interest rate right now is around 7%. So the state is essentially penalizing you for not having liquidity. This is why life insurance makes so much sense for a lot of people. It creates instant liquidity. The check shows up 30 days after the death certificate is issued, and your kids can use it to pay the tax, pay off a mortgage, cover funeral expenses, whatever they need. So let's tie this back to real estate, because that's where I see this play out most often. If you're buying a house in Bucks or Montgomery County right now, you're probably spending somewhere between $600,000 and $900,000 for a single family home in a good school district. Let's say you're buying in Central Bucks for $750,000. You live there for 20 years. You pay down the mortgage. The house appreciates. By the time you pass, it's worth $900,000. You leave it to your 2 kids. They owe $40,500 in inheritance tax just on the house. That's before we even talk about retirement accounts, savings, life insurance, whatever else you have. Now, if one of your kids wants to keep the house, maybe they're planning to move back to the area or they want to rent it out, they need to come up with $40,500 in cash within 9 months. If they don't have it, they're either borrowing against the house, selling it in potentially a bad market, or fighting with their sibling about how to split the burden. The tax isn't theoretical, it creates a deadline, and deadlines plus illiquid assets are where families really get burned. Compare that to the family who planned ahead. They bought a $500,000 life insurance policy when they were in their 50s, paid $400 a month for 15 years. When both parents passed, the kids got $500,000 tax-free. They paid the inheritance tax, covered the funeral, and had money left over. No fire sale, no loan, no stress. I'm not saying life insurance is the only answer, but it's one of the tools that works. And it's one of the things that most people don't think about until it's too late to qualify for affordable coverage. Let me give you a quick contrast I see all the time. One family had everything mapped out. They knew the inheritance tax exposure, they had cash set aside, the house was sold on their terms. Another family inherited a similar home. No plan, no liquidity, the house needed work. They listed quickly, accepted a lower offer, and walked away feeling like they had no choice. Same tax law, very different outcomes. If you're in your 40s or 50s, healthy, and you're thinking about this stuff now, that's the time to act. If you're in your 70s or 80s, the premiums are going to be higher, but it still might make sense depending on your situation. The key is to run the numbers with someone who knows what they're doing, an estate attorney, a financial planner, someone who can look at your specific assets and family structure and really tell you what makes sense. Again, I'm not that person. I'm just a dumb realtor. I help you find the house, but I know enough from working with families for over a decade to tell you this is uncomfortable to ignore and really expensive to misunderstand. Now you know Pennsylvania inheritance tax can be managed. You know the rates, you know what's taxed and what's not, you know the strategies that work and the ones that don't. The key is planning early and filing correctly when the time comes. If you're thinking about making a move to the Philadelphia suburbs, whether you're relocating from out of state or just looking to downsize, schedule a call with me using the link in the description. Or you can download my free Philadelphia Suburbs relocation guide, using the QR code on screen. It walks through everything you need to know about what you're actually getting for your money in each town. Now here's what most people don't realize next. Pennsylvania's inheritance tax is just one piece of the retirement tax puzzle. If you're comparing Pennsylvania to New Jersey, or if you're already living in Jersey and thinking about making the move, the tax math gets a lot more interesting when you factor in income tax, property tax, and how the state treats your retirement accounts. Watch this video next because I break down exactly which state is better for retirees depending on your income, your property value, and whether you're planning to leave assets behind. The answer isn't what most people assume. Thanks for watching, and I'll see you in the next one.